Walgreens Boots Alliance, ticker WBA, is currently trading at $32.17, and over the past month, the stock is down by more than 10%, and over the past 6 months, the stock is down by about 16.5%. Now, if we have a look at the 5-year graph, we can see that there is a clear trend in the decline of the price of the shares of WBA, where the price of the stock has fallen by almost 50% over the past 5 years. So now the question is, when will WBA stop declining in price, and what is the best price you should buy this stock at? Now, if we have a look at the monthly full, we can see quite a few red flags with WBA. One of the main ones being that the company is $36.4 billion in debt, which is about $7 billion more than the capitalization of the stock. And now, even though WBA has been raising their dividends consecutively over the past 47 years, their profits have not been increasing to the extent needed to cover for the dividend growth. Now, if we quickly jump to tip ranks, we can see that the analysts currently have a 24% upside for the company, predicting a price of $39.91 by the end of 2023, with most analysts rating the company as a hold company. Now, to see whether WBA is a good buy at its current trading price, we'll jump over to my automatic stock valuation spreadsheets, where we will have a look at the 9-pillar analysis and find the intrinsic value of WBA using the Graham's formula revised, discounted cash flow model, multiples valuation model, and the dividend discount model, and all these models will lead to our ultimate valuation at the end of the video. Now, if we jump back to the stock screener, right away we can see that the dividend yield for WBA is sitting at almost 6%, a very decent starting dividend yield. The dividend payout is sitting at almost $2 per share per year, and the payout ratio is fairly low, sitting just below 40%. Now, the analyst's current target price is sitting at $41.43, quite a bit higher than the current trading price. The institutional ownership of the company is sitting at almost 62%, and the beta of WBA is sitting at 0.71, which means that you won't see that much volatility with the company. Now, one thing to notice here is that the market capitalization of WBA is sitting at $27.76 billion, but if we direct our attention up here to the right, we can see that the total liabilities of WBA are sitting at almost $60 billion. Now, to me, this is quite a bit of a red flag, but let's have a look at the 9-pillar analysis. We can see that the current rating of WBA is sitting at 7 out of 9. Now we can see that most of the pillars here are actually in the green. We can see that there has been revenue growth over the past 5 years, and that the price to free cash flow is sitting at a very decent value. We can also see that there has been a decrease in the shares outstanding over the few years or so, and the 5-year profit margin is certainly sitting at above 10%, sitting at about 22.14%. Now, if we have a look to the right here, we can see that the net income growth over the past 5 years is averaging at about 150% annually. But now, if we scroll down to the financials of WBA, we can see that since 2015, the net income of the company has not increased by much at all, and that the reason for the large growth rate displayed above is the transition between 2020 and 2021, where the net income grew by 457%. But now let's jump to our first valuation model, the Graham's formula revised. We'll plug in the ticker WBA, and as you can see, all the metrics show up automatically. Now, to get the intrinsic value, we take the earnings per share of the company and multiply by the average yield on AA Corporation bonds. We then multiply that by the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier. We then divide that number by the current yield on AA Corporation bonds to get an intrinsic value of $59.43, about 46% higher than the current trading price. But now let's move to the next valuation model, the discounted cash flow valuation model. As you can see, I have already plugged in the ticker WBA, and the free cash flow over the past 10 years or so shows up automatically, calculating the average growth rate to be at 2.13%. Now, I calculated a free cash flow growth rate of about 2%, and using that percentage, I calculated the future free cash flow over the next 10 years. Now, to move on with the valuation, we need to calculate the present value of that future free cash flow, and we will do that using the discount rate, which is currently sitting at about 6% for WBA. We then sum up all the future free cash flow, add any cash and cash equivalents, subtract total debt, and get an equity value of $27,805. We divide that by the shares outstanding and get an intrinsic value of $32.23, only a few cents higher than the current trading price. Now we can move to our next valuation model, the multiples valuation model. Here I will be comparing WBA to companies that operate in the same sector and have very similar structures to WBA. So I will be taking SNY, DLTR, and CVS. I took these companies' current stock prices and divided by their current earnings per share to get their price to earnings ratio. I averaged out those PE ratios and multiplied by the earnings per share of WBA. Now take into account that WBA currently has a negative earnings per share, and therefore I took the average earnings per share of WBA over the past 2 years. After I multiply the average PE ratio by the average earnings per share of WBA over the past 2 years, I get an intrinsic value of $67.34, quite higher than the current trading price. Now we can jump to the final valuation model, the dividend discount valuation model. Here we plug in the dividend payout over the past 5 years and calculate the average growth rate to be at 3.35%. For the next 2 years, I project a growth rate of 1.7%, as I do believe that WBA will slow down with their dividend increases due to them being heavily in debt. We'll plug in a yearly dividend frequency of 4, as WBA does pay out its dividends quarterly. Then we take the projected growth rate, the next year's dividend, and the WACC, combine it, and get an intrinsic value of $44.42. But now let's move on finding the ultimate value of WBA. We'll plug in the ticker, and we will average out the grams formula, multiples valuation, discounting cash flow valuation, and the dividend discount model to get an intrinsic value of $55.72. Now 73% is quite a big of a difference, and this is mainly due to the multiples valuation. And as WBA is currently sitting on negative earnings per share, we will altogether remove the multiples valuation. And now if we come back to the ultimate valuation, we can see that the intrinsic value of WBA comes out to be $45.36, 41% different to the current trading price. Now if we plug in a margin of safety of 20%, we would be able to buy WBA at $36.29. Now, even though that the intrinsic value is quite higher than the current trading price of WBA, I would be very cautious when buying this firm, as I do believe that they will cut their dividends very soon due to them being heavily in debt. Now, if you find these valuation spreadsheets helpful or interesting, you can access them on my Patreon at the link in the description. With that, if you enjoyed the video, make sure to leave a like and consider subscribing if you want to see more videos like this.